The listing goes live at 11 p.m. You refresh the page 4 times before midnight. 2-bedroom, 1 bath. A city where nobody from your neighborhood buys property. The asking price is $187,000. You have $23,000 saved. It took you 4 years. Your mortgage broker says you qualify. Barely. You sign the papers on a Tuesday. Your hands are slightly unsteady. You don't tell anyone except your mother. She asks if you're sure. You say yes. You are not sure. The tenant moves in 6 weeks later. $1,100 a month. Your mortgage is $980. That's $120 left over before the water heater breaks, before the tenant calls at 9 p.m. on a Saturday because the heat stopped working, before the property tax bill arrives and you realize you didn't account for it correctly. The first year costs you more than it earns. That's not failure, that's tuition. Every investor who has ever scaled paid this exact tuition. The ones who stop here call it a mistake. The ones who continue call it Lesson 1. Lesson 1. The deal doesn't make you money. The knowledge of what went wrong makes you money.
2 years later, you're still in the same property, but something has shifted. You know the plumber's number by heart. You know which repair is urgent and which tenant is testing you. You renegotiate the insurance. You refinance at a lower rate and pull out $18,000 in equity. That $18,000 sits in your account for 11 months while you look at deals. You look at 40 of them. You make offers on 3. 1 is accepted. A duplex. $224,000. Both units occupied. $2,300 combined rent. The math is cleaner this time because you've done the math wrong before. This is the first moment where the machine starts to compound. Not your money, your judgment. You're managing 2 properties now, then 3. You still have a job. You wake up early to answer tenant emails before 8 a.m. You take calls during lunch. Your evenings go to spreadsheets, lease renewals, maintenance bids. Nobody sees this part. They see the number of doors. They don't see the hours behind each door. By property 4, you hire a property manager, 8% of gross rents. It feels expensive until you calculate what your time is worth. Then it feels cheap. That's the shift. You stop thinking like a landlord. You start thinking like an operator.
Lesson 2. Your job is not to manage properties. Your job is to manage capital and systems. The properties manage themselves when the systems are right. You have 6 units now. Total value somewhere near $1.2 million on paper. You don't feel wealthy. You feel leveraged. There's a difference. The bank knows your name, not because you're important, because you're consistent. 3 years of clean financials, on-time debt service, a portfolio that cash flows even when 1 unit sits vacant for 2 months. Consistency is the only currency a lender actually respects. You use a HELOC on property 2 to fund the down payment on property 5. You use the equity in property 5 to approach a small commercial lender about a mixed-use building. 6 units above, 2 retail spaces below. $1.8 million. You've never written a check this size. You write it anyway. The night before closing, you don't sleep. Not from fear, from arithmetic. You run the numbers again at 2 a.m., not because you don't trust them, because the ones who stay in this business are the ones who keep running the numbers, even when they already know the answer. Now you're at 12 units, a property manager, a part-time bookkeeper, an attorney on retainer. You've stopped taking calls from tenants directly. You've started taking calls from brokers, off-market deals, the kind that never appear on Zillow because they don't need to. At this level, the deal flow finds you, not because you're lucky, because you've been consistent long enough that the market knows you close. You close on time. You don't retrade. You don't disappear after due diligence. That reputation took 5 years to build. It is worth more than any single deal you've ever done. Lesson 3. In real estate, your reputation is your access. Access is everything. You have a decision to make. You've been doing this with residential, 2 to 4 units, small multifamily, the kind of deal any qualified buyer can pursue. To get to the next level, you have to change the asset class, or the financing structure, or both. You look at a 32-unit apartment complex, $4.3 million. You cannot buy it alone. You don't need to. You've met people at this point, other investors, a former colleague with capital but no operational experience, a dentist who wants real estate exposure but not the headache. You structure a small syndication. You're the general partner. They're limited. You find the deal, manage the asset, execute the business plan. They provide the equity. You split the returns according to a waterfall structure you've had an attorney draft 3 times until it's clean.
This is the moment the game changes completely. You're no longer just an investor, you're a sponsor. You're responsible for other people's capital now. That weight is different. That weight should feel different. If it doesn't, you're not paying attention. The 32-unit closes. Occupancy is 71% at acquisition. Your business plan calls for renovation of vacant units, rental increases on turnover, expense optimization. 18 months later, occupancy is 94%. NOI is up 38%. You refinance, return a portion of equity to investors ahead of schedule. Your phone starts ringing differently after that. Not tenants, investors, people who heard about the 32-unit, people who want in on the next one. Lesson 4, your first successful syndication is your real resume. Everything before it was practice.
You're running $12 million in assets under management now. A small firm by institutional standards, a serious operation by every other measure. You have a director of acquisitions, an asset manager, a capital-raising relationship that handles investor communications. You don't manage properties anymore. You manage people who manage properties. You're underwriting deals you won't close to stay sharp. You're passing on deals that would have excited you 3 years ago because your standards have moved. That's not arrogance, that's calibration. The market will always produce more deals. The question is, which deals deserve your capital structure, your investor relationships, your reputation? You're approached about a 186-unit complex in a secondary market, $28 million. Institutional quality, the kind of deal that requires a different type of equity partner. Not dentists and former colleagues. Institutional capital, a family office, a smaller fund co-investing alongside you. You fly to 3 cities in 2 weeks. You present to people who have seen 1,000 decks. You know this because they ask questions you haven't heard before. You answer them, not all of them perfectly, but honestly. Honesty is underrated in rooms like this. The deal closes, $28 million. Your name is on the general partnership alongside 2 larger firms. You are the operating partner. You know this asset class. They know the capital markets. You need each other. That's not weakness. That's how the game works at this level. Nobody wins alone above a certain size. Lesson 5. Collaboration at scale is not compromise. It is the model. You're at $60 million in assets under management, 43 employees between your firm and property management, investors across 11 states. You sit on the board of a regional housing nonprofit. Not for optics, because at this level, the housing market is your market. And what happens to housing policy happens to your portfolio. The relationship between your returns and the broader system is no longer abstract. You feel it in rent growth assumptions, in cap rate movements, in the political conversations happening 3 floors above where most investors are looking. You think about the first property sometimes, $187,000. The water heater, the 9 p.m. call. You don't miss it, but you understand now that it was not a small thing. It was the entire foundation. Remove it, and nothing above it exists. Your portfolio crosses $100 million in total asset value on a Thursday. There is no ceremony, no bell, no moment you'd recognize from the outside. You're in a meeting about a refinancing on a 74-unit asset when your asset manager sends you the updated portfolio summary. You look at it for approximately 4 seconds, then you go back to the meeting because the 74 unit needs attention and the number in the summary is not the point. The point is what built it. The point is what comes next. Somewhere in a city that looks nothing like this one, a first-time buyer refreshes a listing at 11 p.m. 2-bedroom, 1-bath, $187,000. Their hands are slightly unsteady when they sign. They think this is about the property. It was never about the property. The machine takes another step forward.